Retirement is supposed to bring peace of mind and simpler finances, but for many Americans, there's an unexpected twist. Social Security benefits can actually be taxed. This comes as a shock to countless retirees who assumed their hard-earned benefits would be tax-free. Since 1984, the income thresholds that determine whether your Social Security is taxed have barely changed. As a result, more and more retirees, even those living on modest incomes, are finding themselves subject to this tax every year. What started as a tax aimed at the wealthy now affects a broad range of middle-income seniors. This shift means that proactive planning is more important than ever if you want to keep more of your retirement income. In this chapter, we'll break down the rules, walk you through the IRS formula, and share practical strategies you can use to minimize how much of your Social Security is taxed. We'll also highlight common mistakes and misconceptions to help you avoid costly surprises. Don't be misled by sensational headlines or rumors. Current laws still mean that many retirees will pay taxes on their benefits, even if they don't consider themselves wealthy. The key is understanding exactly how your total income, including pensions, investments, and part-time work, affects your tax bill, and what steps you can take to manage it. We'll clarify the IRS formula, explain the income thresholds, and outline actionable steps you can take right now to reduce your tax burden and keep more of your benefits. With the right knowledge and a little planning, you can take control of your financial future and protect your retirement income from unnecessary taxes. Let's get started by demystifying how Social Security taxes really work, so you can make informed decisions and enjoy a more secure retirement. This guide is your roadmap to a smarter, more resilient retirement plan, one that helps you keep more of what you've earned. To determine whether your Social Security benefits are taxable, you first need to figure out your combined income. This is a special calculation the IRS uses, and it's not always obvious at first glance. The formula is adjusted gross income, or AGI, plus any non-taxable interest, plus 50% of your Social Security benefits. Each part of this formula plays a key role in the final number. AGI includes most types of income, like wages from a part-time job, withdrawals from IRAs or retirement accounts, pension payments, and any investment income you might have. Next, add in any non-taxable interest you receive, such as interest from municipal bonds. Even though this interest is usually tax-free, the IRS still wants it included in this calculation. Then, take half of your total Social Security benefits for the year and add that to the sum. This step often surprises people, but it's essential for the formula. For example, let's say a retired couple has an AGI of $30,000, no non-taxable interest, and $20,000 in Social Security benefits. Their combined income would be $30,000 plus $0 plus $10,000, totaling $40,000. This combined income number is what the IRS uses to determine how much of your Social Security benefits may be subject to federal income tax. The formula might seem a bit unusual, but it's the IRS's way of measuring your total financial resources, not just your taxable income. Understanding your combined income is the crucial first step in figuring out your potential tax exposure on Social Security benefits. Keep this calculation handy. It forms the foundation for all your Social Security tax planning and helps you avoid surprises at tax time. Next, let's see how these combined income numbers translate into the specific tax thresholds that determine how much of your benefits are taxable. Once you know your combined income, the next step is to check which tax tier you fall into for Social Security benefits. This is a crucial part of retirement planning, as it determines how much of your Social Security income could be subject to federal taxes each year. For single filers, if your combined income is under $25,000, none of your Social Security benefits are taxed. If your income falls between $25,000 and $34,000, up to 50% of your benefits may be taxable. And if your income is over $34,000, £34,000, up to 85% of your benefits could be taxed. These brackets are important to keep in mind as you plan your withdrawals and other sources of income. For married couples filing jointly, the thresholds are a bit higher. If your combined income is under $32,000, you won't pay any tax on your Social Security benefits. If your income is between $32,000 and $44,000, up to 50% of your benefits may be taxable. And if your combined income is over $44,000, up to 85% of your benefits could be taxed. These numbers are key for couples to remember as they budget for retirement. Even a small increase in your income can push you into a higher tax tier, so it's important to monitor all sources of income, including pensions, part-time work, and investment withdrawals. For example, a couple with $40,000 in combined income falls into the 50% taxable range, but just a few $1,000s more could move them into the 85% bracket. Remember, this doesn't mean you pay a 50% or 85% tax rate on your benefits. Instead, it means that up to half or up to 85% of your Social Security benefits are added to your taxable income and then taxed at your regular marginal tax rate. The actual amount you owe depends on your total income and tax bracket. These income thresholds have not changed since they were first introduced in the 1980s, even though the cost of living and average incomes have increased. As a result, more and more retirees are finding themselves subject to Social Security taxes each year. Understanding which tier you fall into can help you make smarter decisions about when to take withdrawals and how to manage your overall tax bill. The ultimate goal is to keep as much of your Social Security as possible in your pocket. By understanding these brackets and planning ahead, you can minimize taxes and make your retirement savings last longer. Smart planning now can lead to greater financial security and peace of mind in the years ahead. Now, let's look at some practical strategies you can use to lower your taxable income and keep more of your Social Security benefits. The order you tap your retirement accounts can make a big difference in your Social Security tax bill. Delaying Social Security until age 70 increases your benefit and gives you years to draw down IRAs or 401ks first. By using your tax-deferred accounts before claiming Social Security, you reduce future required withdrawals and lower your combined income later. This can keep you in a lower tax tier when you finally start benefits. Couples can coordinate. One delays for a bigger benefit, the other claims earlier for cash flow. Strategic withdrawals now mean less taxable income and lower Social Security taxes later. Timing is everything when it comes to minimizing taxes in retirement. Roth conversions are a powerful way to control your retirement tax bill. Move money from a traditional IRA or 401k to a Roth IRA, pay tax now, and enjoy tax-free withdrawals later. Roth withdrawals don't count toward your combined income, so they won't increase the taxable portion of your Social Security. The best time for conversions is after you retire but before you claim Social Security, when your income is lowest. Convert just enough each year to stay in a lower tax bracket. By the time you start Social Security, you'll have a tax-free pool to draw from, keeping your combined income and taxes down. This strategy can save you thousands over your retirement. Roth conversions give you flexibility and peace of mind. At age 73, you must start taking required minimum distributions, RMDs, from traditional IRAs and 401ks. RMDs are taxed as ordinary income and can push your combined income into a higher tax tier, making more of your Social Security taxable. To avoid a tax spike, use your 60s and early 70s to draw down or convert these accounts before RMDs kick in. Smaller account balances mean smaller RMDs and less taxable income later. Proactive planning now prevents a sudden tax hit in your 70s. Don't let RMDs catch you off guard. Plan ahead to keep your tax bill manageable. A little foresight can save you thousands over your retirement. Take control before the IRS forces your hand. If you're charitably inclined and over 71, qualified charitable distributions, QCDs, are a win-win. You can donate up to $105,000 per year directly from your IRA to charity, and it counts toward your RMD. The donated amount is excluded from your taxable income, lowering your combined income, and potentially reducing the taxable portion of your Social Security. QCDs are more effective than taking a withdrawal and then donating, especially since most retirees don't itemize deductions. This strategy lets you support your favorite causes and cut your tax bill at the same time. If your RMD would push you into a higher tax tier, a QCD can keep you below the threshold. It's a simple, powerful tool for both giving and saving. Use QCDs to maximize your impact and minimize your taxes. Working in retirement can boost your income, but also your taxes. If you claim Social Security before full retirement age and earn above the annual limit, your benefits may be temporarily reduced. All earned income increases your AGI and combined income, making it likely that more of your Social Security will be taxed. Once you reach full retirement age, withheld benefits are paid back, but the tax impact remains. Where you live also matters. Most states don't tax Social Security, but a few do. States like Florida and Texas are tax-friendly, while others may tax your benefits if your income is high enough. Consider state taxes, property taxes, and sales taxes when choosing where to retire. Smart location choices can free up thousands for your retirement lifestyle. You have more control over your retirement taxes than you think. The most powerful move. Delay Social Security and use the gap years for Roth conversions and strategic withdrawals. Spend down traditional IRAs before RMDs start to avoid a tax spike later. Use QCDs if you're charitable and over 70, 1-2 to lower your taxable income and satisfy RMDs. Choose your state of residence wisely to minimize state taxes. Start by calculating your combined income and see where you fall in the tax tiers. Each small step, delaying benefits, converting to Roth, using QCDs, adds up to big savings. Proactive planning means more money for you and your family. Retirement should be about peace of mind, not tax surprises. Take charge now to make your retirement as rewarding as possible.